Okay, so what we need is we have to open the final report part in the Excel in CoSpace. Download it somewhere, doesn't matter, we will use it. And also the other thing what we need is from CoSpace, because I uploaded the most recent versions of the Excel sheets here in 08 probability of default ozone O. So we are just downloading and opening it. There are actually 4 different versions. So this is the original one. So in this case we can get always the baseline data. So what happens if you are not doing anything. And then we can see that, oh, what is happening on the bond funding, equity funding, lease. And also in the case of equity, we were able to add last week the foreign exchange exposure part. So practically we need all of them, but mostly we need this one here. So first of all, let's open the case study. So obviously we need some kind of a vision, because this is what we learned at marketing. So in this case, my vision is to make the world a better place by uniting oxygen and hydrogen at orbital speeds. This is stupid enough, but it's a mission. Okay, we need a title, so this is case study. Obviously we need the group members here. Then we need an initial problem. So obviously we have to talk about why profitability of the company is terrible, why the product proposal, how does it look like, then what kind of launch numbers can we expect, what will happen with the value, and what is the probability of default for all of this. Obviously we can ask the question that what is the probability of default here, but if we are opening our Excel sheets, then we can see that was extended with one additional sheet, and it practically estimates an ozone default for probability. So it uses total assets, total liabilities, working capital, current assets, current liabilities, net income, which is another name for pre-tax profit, funds from operations, and a change of the net income. So again, the change of the wow, this is one. Yeah. So the pre-tax profit changes. You are changing, just always at the same level. Okay. And and after that, from this one, the ozone score will be accounted. And then we have this probability of default for each time period. We can see that, oh, this is simple. So at the beginning, we have 50% of probability for defaulting in the first year, then it shrinks down to 13, and then it will be 0. You can ask the question that, is this well calibrated? Obviously I did it for Ariane 6 as well, and then we can see that in this case probability of default is always fluctuating around 30%. So this is the original state, so we can see that, okay, this one is an improvement. Yeah. So we have to go through only this item. So let's see initial market parameters. So what is happening here on the market? Obviously, what kind of interest rates do we have on debt? What kind of interest rates do we have on savings? The exchange rates and inflation and so on. So in this case, we can just say that we can grab this data already from Excel, because in the profit and loss statement we have the interest on debt, the exchange rate also, just we know that this one is different. So practically we just have to copy this data to here and then just fill up everything what we needed, what we had here. So in case of bond funding also we have some data. So practically we just have to compile that what was used as an external data during our calculations, because we have no impact on this one. So again, interest rates, the foreign exchange rate, which was used for the calculation. We know that this was defined here, so this is the current exchange rate. It changed a lot since the last semester, so we can see that Trump was successful to destroy the exchange rate. And then we can see inflation. Unfortunately, he was also efficient on this part as well. And also we can see that right now we don't have many of this data, so obviously what you can find in the database, then we can just delete it. Okay, but now new product design. So we have to do something. And obviously this something will come from the product part of the sheet. So in this case, you just have to fill in that, what is the name of the asset? How much do I need from them? So we can see that, oh, this was coming from the main component C3. So this is the name for this one. So if I would like to just transfer it to Prometheus, I would just have to say that, okay, now it's F3. How many do I need from this? Required number. Okay, I need 2. Okay, this is still 2. What is the price? It's 2 million. Okay. In this case, there is this multiplication. We don't have to care about it because we know. Obviously, we know that there are 3 engines in it. We would like to put 2 engines on the bottom and then only 1 at the top. Then we can see that, okay, this is also F. Now we were able to cut down our expenditure. We can say also that we would like to use aluminium or carbon composite. Right now, let's go for the cheap one because we like cheap stuff. And then we need fueling. So C7 was the fuel requirement. Okay, now we are moving from hydrogen, which is really light, to methane. So this is why we have to deal with this data. Obviously, we have to update it. So again, from C, it will be F7. Then the price. We have to find some kind of a price here. So let's go back to the case study. Oh my god. So in the case of propellant, if we are opening the case study, we can see that, oh, methane. Oh, good old days when it was so cheap. So 500 is the price. Obviously, we are talking about millions, so 0.5 is the 500. Then prices are shrinking. Fairing, we don't care, we are throwing it away, so this is 7 million euros. And then we have this really cheap vehicle, and otherwise we don't have to care about anything anymore. Oh no, we have to care because right now our margin is too low, so we have to stay under 60 million euros, so practically this is our only objective here. But until then we can just increase these margins as much as possible. 3? Yes. 3.1. This is still good. 3.3. No, this is too much. 2. Okay, so now we defined the margin. So practically I'm just marking with yellow that, okay, we needed intervention here, here. This was automatic. There. By checking the fuel type, checking the mass. Oh, this is also F. So these were the only issues where we have to intervene, and after that obviously we had to check for the margin to calibrate it nicely to have most of the market and also optimize the revenue. So now we can just copy and paste. And then we can say that, okay, this is the price for launch. Obviously, the presentation can be nicer. So right now, this is ugly. Ugly but efficient. So we can see also launch numbers here. This is coming from this sheet. So until we are staying under 60, then we have this launch number. So this can be inherited by other designs. Otherwise, if we are not saying that I would like to use Merlin 1D, so until not this column is not used, then we can keep this territory completely as the same. So probabilities of explosion, success, everything will be the same. So obviously Merlin would provide us even cheaper price tags, but also in this case it would generate us US dollar related expenditures because we have to import the engines. But otherwise, if you would like to use them, then obviously you have to calculate with these probabilities. It's good because you can cut losses or expenditures even further. Just in this case, the landing explosion will be limited. So this is how we should calculate it. So this one should be updated in case of Merlin, otherwise not. Then, what is the next step? Okay, we can close this one down. Profit and value. So what happens here? So in this case, we have this beautiful graph, which is absolutely outdated, but still contains all the necessary components. So we need revenue, we need EBIT, and we need profit for the year. So let's check everything. So obviously revenue remains the same, so it doesn't matter that how we are operating. Already the unit price is coming from the previous sheets. We know that this will be the number of launches. This is the same. Probability of regaining revenue. This is also the same. So revenue, this is what we need here. Then, again, probability of successful expenditure cut. This is again coming from the product sheet, so we don't have to touch anything. Unit cost coming from the previous sheets. Again, this is practically all our expenditures will come from the previous sheets. Only what was changed before the inflation, but we know that we don't want to fire people and become profitable that way. We are not United Launch Alliance, so we don't have to touch anything here again. Then we have EBIT. Now it's nicely calculated. And then we have paid interests. Later on we will optimize this one, or at least study that one. And obviously we can have hedging. Do we have hedging? Valuation, foreign exchange exposure. For some reason we didn't use any kind of a hedging. So yeah, we can survive. So we are selecting no hedge strategy. Still we can say, okay, we don't have financial lease as well because we are just using equity funding. Pre-tax profit, it will be estimated automatically. Corporate income tax, we are in France and we are not optimizing taxes. We are paying some dividend for our shareholders, and then we have the profit for the year. So what kind of data do we need? We need revenue, EBIT, and profit of the year. So revenue, EBIT, and profit of the year. we still have to update this one with the new numbers. Obviously we need some formatting here, so I need to say that these are in million euros, so not in cats or tonnage, and also we have to say that oh, come on. Doesn't matter, so the other is year, but this is good enough. Then share price changes. So in this case we have to collect that what happens if we are applying different funding techniques and exchange rates and so on. So let's go through everything. So right now we have this equity funding thingy, so let's check valuation. So that was the original share price. This is not changing. But we have to still check that what happens with bond funding and lease. So unfortunately we have to go back, bond funding and lease funding must be opened, and then we have to do the same thing. So we have to go to product in both. We have to teach them that, okay, what happened here. We can brute force also the Excel, so we can say that doesn't matter, only values should be added in, then it will go through immediately, so we don't have to change anything. Again, this is quite brute force. 3.2, so we changed all of you. Copy, pasting values, 3.2. So the whole setup is the same, and after that we can see that after that we don't have to touch the profit and loss statement. Still do we need, yeah, the funding is already calibrated, some kind of a funding. Is this enough? This is completely enough. So you can say that, yeah, let's take this one for the bond, and this is the lease scenario. We can still check that, okay, this is still 100 million euros what we need here, and the financial lease is calculated here. So again, not touching anything, just we can say that, yep, we can just grabbing the lease. Oh my god, which one is you? I mean, which one is dynamically changing? So you, they are all fixed. So now we need the value of equity from here. So C33 will be. So let's bring back everything to the initial valuation part. Let's say that, okay, we don't want to have any kind of a problem. So from bond, we are just picking up. These are the live numbers actually calculated. So bond financing. Then we need value of equity based on equity financing. And we need also the lease scenario. Financing. Yeah. And also we can see that that was original share price. So at the end of the day, what we need here is we can refer to here. Then let's have another one, and then we can value of equity under different funding scenarios. So we know that at the end of the day I was choosing this one because it was more comfortable. So, and also we can highlight that, okay, that was utterly useless, so that was the original state. If we are not doing anything, then this will happen. And again, we need some. So these are in million euros. And now we can say that so this is the added value of the whole project. So originally that was this terrible, and after that practically it doesn't matter which one is chosen. We have much bigger achievements here, so practically we can double, triple, yeah, so good. Then foreign exchange exposure. So okay, what we can do here is, let's go back to foreign exchange exposure. Then here we have to say that, oh, we can just copy everything. So first of all, this is the kind of exposure that foreign exchange exposure is related to our contract with Amazon for 18 launches of the Leo constellation. It's really funny because during last week they had, for example, another launch for Amazon, so this business is already happening. Just okay, in the case of case study, FX is we can delay things already. So now Amazon has already 300 satellites on orbit, and they need 3,000 to make things operational. So still there is some time, but otherwise we can say that we can copy things here. Again, your presentation can be much nicer, just this one is ugly. So number of launches for Amazon, and obviously we don't need this column here or this row here because this is already the we defined it already. So we have revenues, so number of missions, revenues related to them. Obviously expenditures are or revenues are bigger than expenditure, so this one is positive. So we are expecting the appreciation of the we are preferring the depreciation of the euro, so we can say that. And then we can say that, okay, what are the expectations about foreign exchange rates? We can check futures markets. We can have worst case scenario, best case scenario. So let's make maybe a bar diagram again from all of this data, because presentation is a good thing. Oh, come on. Thanks. So we can see that for each year we have some kind of data from the futures market or from our simulations. And also we can see that right now we have to sell this, so this can be your option fees. Maybe you will go up. You can be shortened. And then we can still say that maybe don't want to run any of this, because it would create an additional problem that, okay, in the profit and loss statement we can say that there is this hedge exposures. So this equals revenues, well, no, this one, multiplied by the put fee. So okay, obviously nothing happens, just here you should. C22. Put option fee. Okay, let's do it again. So put multiplied . Oh, there are the dollar marks. I don't know why there are dollar marks in it, but let's remove them. Now you are live. Okay, so this is the problem what we have here, because we can see that, oh, what happens with valuation? Can it contribute anyhow to the value of the company? Now we are only testing the equity financing, because this is only relevant for us. And nope. Equity financing. So we can say that, okay, no hedge versus total hedge strategies. This one contributes to less value. Practically, we can lose. Again, we need units here, so million euros. So we are losing 200 million euros of value on overall equity if we are doing a total hedge. So no, we don't want to do this. So but still we have to write about this one. So we would follow no hedge strategy. So again, this is absolutely up on the preferences of the investors. This is absolutely up to the preferences of the management. Right now we can say that, okay, this number is bigger than that number. So that's what we are saying that, okay, nope. So at this point, I will just go back and say that, okay, hedging is not working anymore. So this is zeroed out. No, you can go home and never come back. We will run happily this exposure anyway. Then let's see, what do we have? Probability of default, so or sensitivity. Again, this is useless. Let's go for fancy data sets. And this is probability of default here. And we can copy you. We can say that, okay, right now everybody's probable. So let's have equity. Only we have bond, we have lease, and also we can have equity and total hedge. We can play the game at the end of the day. So what are you bond funding? Probability of default, we can just copy, paste, again just the values, not all the functions. Then we can go for the lease, copy, paste, and we can do also the total hedge. So unfortunately in this case I have to move back and reinitiate my friend. Exposure, again, you multiplied by the dollar marks, I don't know, there you are, and put option fee. Oops. Then probability of default, did it change? I have no idea, but now I will destroy this again. Okay, so in the case of probability of default, obviously these are percentages. And we need also the original. So let's open the non-reusable scenario. Also we have here the data, so we just have to copy. Then no, this should, yeah, okay, this is good. Maybe it's not the best presentation, so let's go back to line diagrams. Yes, and also we are not politicians, so the scaling should be feasible. So 100% is when we are defaulting and 0 is when we are not going to default, so we can see that. Probability of default by Ozono score. So Ozono score was developed in the 80s, so it's better than Altman Z, because Altman Z was developed in the 60s, and also it was not providing us exact probabilities for default, just it says that, okay, if we are at a certain range of numbers, then maybe the company will not default within 2 years. At least Ozono is providing us probabilities Still, this was calibrated for US companies or on US sample and only publicly listed companies, but it's better-ish. After that, it was tested back on many different samples, and it's quite robust, so it doesn't matter if we are using it for our French company here. Again, so once you filled up with your own numbers, except this one because this is the original state, maybe we can also increase the font size, and then we can see that what was our contribution to the whole business, that we were able to decrease the probability of default, obviously. So from this number, we have these numbers. Great. So, conclusion. Initial problems were that we had to cut expenditures. We had to cut expenditures by removing unnecessary manufacturing needs because of partial rapid usability for the first stage. I think everybody will do this, so we don't need any modification. Our new launch vehicle was based upon legacy hardware. Now this is what will diverge, so it was based upon it can be legacy hardware if you are using Ariane or Vulkan 2.1. Otherwise, this will be some kind of another hardware. So in my case, it will be Prometheus engine. And our launch fee was reduced to this number, where we can recover this number here. So obviously, here we have to say that, oh, let's go back to profit and loss statement. In the case of products, and then we can say that, okay, this is my launch price. .3, and we can recover what? This 15.5 per launch, and we have only this expected additional manufacturing costs from here, so 12.6. Again, this is coming from the product Excel sheet. This will find our profitability for the next 5 years ahead. Yes, it did. To stabilize the company during the transitional years, we need, at least I need, this 100 million euros is still better as a cushion, because we need a financial runway if things are going south or we have delays and so on. Things are exploding here and there, so obviously we need additional insurance of some shares. Again, in my case, it was defined number of new shares. So this is what I should copy. Okay, so 17,000 shares, and the original fair value of the shares was this number. Again, this will come from here. Okay. This is where we can see that numbers are changing back and forth during the different years of the, and now we can say that, okay, let's say equity, because I did everything on equity base, not share value. So in this million of euro, in this case, this is the same for everybody, so you don't have to change this one. After the dilution, doesn't matter. If the market accepts the feasibility of the strategy, it should converge towards this number here. So, yep, U. And again, this is equity, so million euros. since we are buying the shares at this value, we could... Oh, then the dilution was maybe... no, this is some fine-tuning. Like we can say that all added value is estimated as euro. So this is the money what we invested. This is the profit at the end of the day. So C36 minus F32. So obviously this was the new equity value. This is the original equity value. We have to divide by the package what we have here. And then we can say that, oh, the profitability is like all what we gained minus initial investment divided by initial investment. So we can say that this is a nice 126% increase. No, this is not increase, this is profit. So again, we have to change U and U. So this is coming from the datasheet itself. So these numbers should be defined. Also, what we can see here in the probability of default, these numbers will also come from, not you. The original, again, this one will stay. You don't have to modify that one. These numbers will be updated because they are located in the individual sheets. So again, what you have to do at the end of the day is, not you. So what you have to do at the end of the day is just to update the product sheet, and also you have to define profit and loss statement. So what you have to define in the profit and loss statement, that how much money do you need as a financial runway. So I was really conservative. You can increase this number, decrease this number. Just always check, please, that okay, does it relate to debt anyhow? Because right now we are just raising common equity. So this is the equity scenario. So this money goes here. In the case of bond scenario, this money here goes here in the debt related funding. And in the case of the lease, where are you going? I didn't do anything with that one. So in this case, the whole balance sheet is flowed, but at least I was able to raise the cash. So the asset side is good. This one is... my friends in the accounting department would be unhappy for that one, but maybe the debt should be increased. Anyway, so we can say that you should do these steps, and after that the Excel should do its part of the job. Also, you have to play here, so you have to highlight that okay, what happens if we are doing anything. Also, you have to check that is your product related anyhow to US dollars. Again, the main component. From the US we have to buy stuff for US dollars. In case of Russia we can say that okay, we can buy it for euros. Again, BA4, this is again US company, so we can say that again we have to buy it for US dollars. Also Raptor 2, now we should write 3 because this will be operational next week if it flies. Anyhow, so it will be operational in one way or another. So now they changed the version number. Still, we can say that pricing and everything. Performance is a bit bigger, but right now it doesn't matter for us. So, all these 3 engines must be purchased for US dollars. So that's why exposure here can be affected because you have some expenditures. I don't have it because I'm using it. I have only US dollar revenues, and after that I don't care. So we have to test this one, and after that we can say that, oh, this is the beautiful conclusion. So now we can wrap this thing up, and practically that's all what we need. So you can see here that within 50 minutes we were able to finish the whole case study if we are efficient enough.